And there you go. So we're now recording live. So anyway, we've dropped below all of these key moving averages, and we're hitting numbers that we haven't seen in a while. I'm going to zoom out back here, and you can see the last time we were back this low was back in March. So we're rapidly approaching here. I mean, we've totally broken down here on the bond market, and it's starting to adversely affect equities right now. So there's your reason. But so what do we really do about it? I mean, we have had a market that has done nothing but this, and when a market does nothing but this, this is basically just responsive selling and buying. So this is nothing but buying. So what I wanted to do today is the biggest question that new traders and medium traders, and it's basically, what stocks do I pick? How do I trade these stocks? What's an entry point? When do I take profits? When do I add? When do I get out? I mean, these are all questions, and these are personal questions, because there really isn't no one answer. So what you do is you basically learn what the market is telling you, and then set something up that makes sense to you. So basically, what do? I look for a chart that makes sense. Now, so let me show you something like this. Now, this is the ES futures, but we're going to look at the Dow. So we're going to look at stocks on the Dow here. So here's Apple. Now, take a look at this chart. Now, what we see is this is a chart of Apple. And if you're saying to me, well, I want to trade this stock. So you're looking at this stock and you're trying to decide if this is a good stock to trade. If you're asking yourself if this is a good stock to trade and you're looking at the chart, you'll say, well, maybe I could do puts on this, but the market is going up and the whole bit. Maybe that's not the stock. Now, would you rather trade a chart like this, or would you rather trade a chart like this? Now, if I'm looking at this chart, I mean, I'm looking for long trades. I mean, there's no two ways about it. So what we want to do is, let's put some set of rules together, and let's try to understand what some of these things are telling you, and then we're going to talk a little bit about indicators. But the way I'm going to show you how I use indicators is going to be something that's going to be kind of unique. You've probably never seen this. And then, because we're trading options, I'm going to put some volatility studies on here that's really going to kind of package and put everything together for you. So basically, buckle up. So what I have right here is I have 4 moving averages. And you could write this down, because I'm going to basically show this as a chart setup that you could do for yourself. Okay, so the first moving average, and I've seen it referenced on here that Al talks about it a little bit, is we talk about the 8-period exponential moving average. Now, the 8 exponential moving average has been widely used. It's becoming more and more popular, and it's widely used, and a lot of traders use it. A lot of day traders and a lot of swing traders are using it. So they're referring to it as the T line or the trigger line. And the way it basically is when you look at certain candle patterns, a break above the candle pattern, using a candle pattern, and a break above the T line is a signal to go long. So this stock is very simple, because Cisco has just been like this. So let's look at something like this, something like Boeing. All right, so you can see that here the 8-period moving average, let's set a rule for ourselves, is that if we want to break and go long on a break of the 8-period moving average, that's a rule that we're not going to go long until the stock actually breaks the 8 EMA. So the first moving average we're going to put on there is the 8-period moving average. So the second moving average we're going to put on here is the 20-period EMA. So when you combine the 8 and the 20, well, why do we use the 20? We're using the 20 because it's also extremely widely used. So traders are creatures of habit. and everybody looks at the same thing. The only thing that's different is how they are interpreting it. So everybody interprets it different, but the 20-period moving average is a wonderful moving average to use as your pullback add-on, because there are a lot of people who trade this 20-period moving average, and we're going to see a lot of different examples on how to use it. So let's set a second rule for ourselves that says we're going to add to our chart the 20-period exponential moving average, and we are only going to trade a break of the T line when stocks are above both of these moving averages. And you know they could be inversed, but I want you to only trade on a break of the T line when it's also above the 20-period moving average. And as long as, and we are valid and staying in this trade as long as stocks remain above the 8-period moving average. And I'm going to add something to that shortly. Okay, so let's finish our chart setup first. So now we have two moving averages. Now we're going to add a third moving average. And the third moving average is going to be a simple moving average. And it's going to be the 50-period simple moving average, or the 50 SMA. So you can write that down. Now, what's the difference between an exponential and a simple moving average? And I'm sure many of you know, but many of you may not know. And the difference is that these numbers, when you say 20, when you say 8, when you say 50, what it does is it takes those bars, it does a look back of those bars, and it takes the average of them and it plots its point. So if you're doing 8, it looks at 8 periods. If you're doing 20, it looks at 20 periods. If you're looking at 50, it looks at 50 periods. Exponential simply means that there is more significance or relevance to the more current trades than back in the future. So by doing that, they're actually changing it a little bit, and I'll show you the difference. So the same thing with the 20 exponential moving average. We're going back 20 periods. We're taking them all, we're dividing them by 20, and everything has an equal weight. The simple moving average has an equal weight. The exponential moving average says that we are going to apply a little more significance to these newer bars, and that should change the plot a little bit. So let's take a look at that. So if we wanted to add a study, and we're going to add a simple moving average. Give me 1 second. All studies, simple moving average. So we're adding a simple moving average. So you can see that there is a difference between the two moving averages. And the difference is the difference between exponential and simple. Okay, so you see there actually is a difference. Actually, let me change that. And let's change that to 20. 20. Okay, and we're also going to change the color to magenta. We're going to apply it, and there it is. Okay, so now you can see the difference. So there's the difference on the 20 between the simple moving average and the exponential moving average. On the shorter time frames, we want something that has a little bit more sensitivity. So by having a little bit more sensitivity, you can see there's a little bit difference, but we want it to have that little bit of sensitivity. So we're going to remove that study now. And I just wanted to show you that. So now we're going to do the same thing with the 50. Sorry for a minute. My headset is... Okay. And we're also finally going to add the 200-period simple moving average. The 200-period simple moving average is an institutional moving average. Every institution, every trader, everybody has that moving average plotted because it basically is the line in the sand. Many fund managers will actually sell many shares of any type of issue that drops below its 200-period moving average because the 200-period moving average is said to be a bear market. So typically when a stock trades below the 200 period moving average, it's said to be in a bear market, and a lot of institutions drop it. So we want to have that plot present. Okay, so we have our 4 moving averages, and I'm going to show you how we're going to use them in a little while. Okay, so now I want to add a study. Okay, so we're going to add a study called the RSI. Now, a lot of you know what the RSI is. Studies come in various shapes and forms, but they really break down into a couple of different classes. They're either momentum or they're oscillators. Okay, a momentum study basically does just what it says. It follows the momentum of the stock. Something like a MACD would be a momentum indicator. An oscillator is a bound oscillator, which typically goes between 0 and 100. And then it has different measurements of where it's said to be overbought and oversold. I have a real problem with that because a stock, who's to say when a stock is overbought, or who's to say when a stock is oversold? And what do you do when a stock is overbought or oversold? If it's overbought, does that mean you sell it? Or when it's oversold, does that mean you buy it? Well, that could be a trigger for you to do that, but more traders have lost money blindly following that logic than who've made money, because stocks can remain overbought and oversold a lot longer than you and I could remain solvent. So that clearly isn't the best way to use this indicator. And what I want to do is let's look at Cisco. Okay, here's a perfect example. So right now the system has set 70 as the overbought indicator, and they set 30 as the oversold indicator. So look when Cisco broke into overbought territory. It broke into overbought territory on this earnings announcement going back into November. So now the stock was technically overbought. So anybody who sold this stock because it was overbought, figuring that, oh, the stock is due to drop because it's overbought. Well, look how long it's been overbought. So basically, and then look at the number that it is. So it's over 70, and it has some sort of arbitrary number associated with it over here, but it doesn't correlate to the stock price. Look at the stock price. Stock price has just been on a tear, going from 36 and change all the way to 42 or 43. But look at this indicator. I mean, this indicator just stays completely overbought. So it basically has lost its meaning. However, we could modify it a little bit, and I'm going to show you how I use the RSI, and then maybe it'll have a little sense when we combine it with everything else. So what I want to do is I want to go to my studies, and I want to look at this RSI, and we're going to modify it. So the first thing we're going to do is we're going to drop it down from 14 periods, and I want to make it a little bit more responsive. So what I do is I drop it down from 14 periods to 7 periods. When you drop it down to 7 periods, that means it's only going to look back at the last 7 bars. And for me, 7 bars is a lot faster than 14 bars. So it's going to respond. So I want the RSI to respond a little quicker. The other thing is I'm going to get rid of this overbought, and I'm going to set this overbought to 50. And this one right here, oversold, I don't even want to see it because it's irrelevant to me. So what I'm going to do is I'm going to reset it that way. And I'm going to apply it and leave it like that. So now, for me, the RSI makes a lot more sense to me because I am going to use this 50 line as one of my triggers to get into a stock. So if let's look at something like Disney. Disney's not a really good chart. But how I'm going to use this is I am waiting for a stock that has been overbought to pull back. And I want it to pull back below the 50 line. And that is my trigger. My trigger is going to be when it resumes beyond the 50 line. So the stock pulls back below 50 and then resumes above 50. And then once it resumes above 50, if it breaks above the T line, and the T line is also above the 20-period moving average, I could initiate a buy or a call or anything like that. And that's a fundamentally a big part of how I trade this. So let's look at, if we look at something like Caterpillar. So we could see that, you know, these are stocks that have actually just always been in an uptrend. So these are in an uptrend, and this is kind of like one of the ways how I use it to trade. Now, there's also something else that I do. And remember, in my last class, I talked about volatility, and basically implied volatility and historical volatility. When we're trading options, remember I said implied volatility is the market pricing in the expected move and how it feels. So how do we know if implied volatility is high or low or relative to what? So what I want to do is I want to add a volatility study. So I'm going to add implied and I'm also going to add historical. Okay. And I'm also going to put them in the same window. By putting them in the same window, you get a whole new view of it. So here we go. And now, I basically have everything I need. I have everything I need to trade with. And if we take this apart and look at it, historical volatility is this purple line here. What historical volatility is it's telling you what happened in the past. This is past or realized volatility. Implied volatility tells you what the market is implying. Now, remember what I told you. When implied volatility goes up, option premiums go up. When implied volatility drops, option premiums go down. What's significant to us is volatility expensive relative to itself? That's how you know if you should be looking at buying calls or buying puts, or if you are a seller of options. This is really very key for you, because when you are a seller of options, you like to sell high volatility because you get your best bang for the buck on the premiums. So if I were to look at Caterpillar right now, I see Caterpillar has actually started to sell off a little bit over the past few days. And volatility goes up when prices drop, because you're putting more fear in the market, and it just adds to the volatility. And volatility means uncertainty. Volatility means anything that could make big moves in the market, so your premiums rise. So buying options when volatility is very high gets a little bit dicey, and that's where you come into the idea about spreads to offset some of that. But you will definitely pay up for premium when you buy calls in this type of environment here. So let's talk about the top of the chart here, and let's talk about the about the stock prices. So as the stock prices go up, we are above the T line. We are free and clear to stay in this trade. Once we drop below the T line, or you see this thing start to fall off, we're in our little caution area right here. The caution area means we're approaching the 20-period exponential moving average. The 20-period exponential moving average is always a support line, and it's always a resistance line. It serves as both. The reason is because it's so significant to traders that traders treat it both as support and resistance. So there's always stock there. So it will cause a pause on the way down, and it will cause a resistance on the way up. So typically what I do is I wait when it hits the 20-period exponential moving average. This is an area here where I don't take profits, but I certainly look to potentially add, when they say add on a pullback, this is my pullback point. My pullback point is the 20-period exponential moving average. So I look here to add. Now, what happens if it continues to go down? I will only add on the reversal. So here we have a little bit of support right here. We had price rejection here. It came back up. Now we have an inside bar. That could be reflecting the fact that the market has been terrible today. So the market dropped. So we have an inside bar. However, on a break again and a break above the T line, I'm still basically in this trade, and I might even consider adding a little bit. My line in the sand when to get out is really this 50-period simple moving average right here. This is my definite get out point, because if once you hit here, this is really the line that says we are looking at a potential change in momentum, a momentum shift. And when you hit the 200, you're looking at a complete trend change. So you're starting to lose your momentum over here, and then you're changing your trend over here, and then you're only looking really at not adding, but you definitely want to exit your positions when you're somewhere around the 50-period moving average. So let's look at a stock like Disney. So we could see, if we look at a stock like Disney, Disney has been oscillating right here. So a stock that's like this, I'm not really trading a stock that does this, because I don't see a trend here. Your longer period moving, so you're flat on the 200, and your 50 is still a little high, but you have a cross between the 50 and 200. Disney stock right here would not be in play for me, because I don't see a clear trend. Your T line is moving sideways. Your 20 exponential moving average is moving sideways. So let's make a rule for ourselves that says that if we're not seeing a clear trend, or we're seeing sideways action, this stock has just as much the propensity to go up as it does to go down. So when we're moving sideways, this is not really a stock that I want to invest in right now. Okay, so let's look at another one. So let's look at GE. Okay, now you're looking at the other end of the spectrum. So now we have GE stock. So GE stock is definitely, we are below the 200 moving average. We're also below the 50 moving average. We're below the T line. Now, just the way you think about stocks that are going up, you think the same way about stocks going down. I'm certainly not buying calls on GE, and if I'm doing anything with GE, I'm looking at puts. I'm looking for the stock to really go down. You don't anticipate saying it's oversold and it's going to go up, because that's meaningless. The price will tell you. The price will tell you what has to be. One of you just sent me a note that says I can't hear anything. I think we're all good on that. But this is going to be also recorded, so you'll be able to pick it up. But I need you guys to understand that don't anticipate everything, because the market is going to, you don't need to get in front of a moving train. The markets are going to make themselves perfectly clear. One of my favorite trading stocks right here is Microsoft. Okay, so Microsoft, let's take a look at Microsoft. And what happens is here that if we go back to October, we had some positive earnings and we've moved sideways. We fell back. We actually fell below the 20 exponential moving average. We never quite did touch the 50-period moving average. So those of you that are conservative might have thought about getting out over here. You might have thought about that. But if you didn't and wanted to keep the rules straight and say, until this thing closes below the 50-period moving average, I'm not going out, you had another chance right here to get right back in on this break above the T line. Now notice how we stay above the T line throughout, and you've never been given a reason to do anything with this stock other than to stay in it. So when you ask yourself, when should I get out? When should I get out? Let the market help you get out. Now, I am going to say something about taking profits. Now, you should set some sort of goals for yourself. And we can set some rules on what that should be. And one of the rules is that it should be a proportion or a percentage of how much you're risking on the trade. So, for example, if I'm risking $500 on the trade, and that's my total risk at expiration if everything falls, if everything falls to pieces, I'm going to risk a total of $500 on a trade. However, you could set a stop loss for yourself at the 50-period moving average, which would probably, save you some of this $500. But based on this $500, I want some sort of return. So maybe I buy 10 contracts here. So maybe I buy 10 contracts, and when I hit a certain gain, so if my investment is $500, and maybe when I'm up, maybe 20%, and I've made $100, maybe I'll take 2 contracts off. Just to book some profits. This is something that's personal to you. But what I do want to say is never give back a gain. And, a binary event's going to happen, and we'll look at Win in a minute to give you a perfect example of the scariest thing that happens in the market to anyone. But if I've got 20 contracts on, and I'm up 15 or 20%, I'll take 5 off. There's nothing bad about that. There's nothing wrong with booking a profit. If it continues to go up, I'm happy. I'm still making money with the other 15, but I've put some money in my pocket. I've had my payday. I've had a successful trade. Now I'm free to let the stock move a little bit more and see what happens. But as long as I am above this T line, I am golden. I am absolutely fine. So it's a matter of you getting used to what makes sense to you. So you could set a profit target that's based on a dollar amount, or you could set a profit target that says, you know what, if it breaks below the T line, like it did over here, you can maybe take some partial profits just to lower it but I want you to still not really do that as long as you're above the 20 exponential moving average, because this is a really big support line. So in the case of Microsoft, we're still golden and we don't have to do anything with this trade because this trade is still in a raging uptrend. Now, conversely, let's look at this. Look at what happened here. Now, here's everybody's worst nightmare. So I go long Win over here. Here's my break of the T line. I mean, I could have done it back here, but let's just say we're working in 2017. I'm not really doing anything over here because based on our rules, let me widen it a little bit for you. I'm still below the T line here, and I'm right in between, and I'm between the 50 and the 20. I'm not interested here. Here I got a lot of interest. I have broke above the T line. And what happens is according to my rules, is I am going long on the first print that's above the high of this bar. Okay? And that typically also would be right here. But look what happened here. We've also broken above the 50 on the RSI on this candle. So there was your set. Here was your confirmation. So I've got an RSI that's broken above 50. I've got a close above the T line. I am all set to take this trade on my first print above the close of this bar. So we're here, we're long, we're loving life all the way up here. Look at this move from 166 to 190 to 200. And then what happens? Well, we have something called a binary event. Now, you don't see these things coming. So you got the news that comes out that says Steve Wynn has been accused of sexual harassment. Then it says Steve Wynn has been asked to step down from the Republican board that he's been serving on. So you have a 20% drop. So you go all the way from here down to here. Mind you, you're still here. We did bounce off the 20 for a minute there, didn't we? We came right down to the 20, which I told you would be support. It closed a little bit above it, but the next morning, the bad news just kept going and it broke down. Look what happened at the 50. You have a bunch of support at the 50. You have buyers stepping in. You've got shorts coming in here. And now everybody here at the 50 is short. Everybody's short here. So you've got the market continues down. These guys are all short. The next morning, and this was this morning, I knew when was a buy. And as soon as I seen it print positive, when the market dropped 200 and I see Win holding that it was up $1, I said this stock's going to reverse today. And sure enough, as the stock starts moving up, guess what? You got nothing but short covering. See that you have nothing but short covering all over the place. Okay? And this is why the stock is now up $7.81, and we still got another half an hour to go. Now, is it going to close above this? I don't know. I don't really care. Now, would I be a buyer above here tomorrow? I think I would wait. I think I would wait to see if we still have some responsive selling. You definitely, if you've ever learned about gaps, and I could do a class on gaps, markets love to fill gaps. So I believe that we will close this gap here. So I would be comfortable going long. I would be comfortable going long up here, but I notice we will hit a little bit of a wall over here once we close this gap with all that. So many people choked on this move down here because 20% is a big move. 20% is a very big move. So if you had options, if you had long calls, you lost more than half. You lost more than half of your investment in those calls. Okay, somebody wrote something. I don't know what it is. Somebody wrote something. Can you please type it in the chat room, because I don't see the messages. Don't stay up on the join me screen. So anyway, these are binary events, and these will catch us, and they will always happen. They happen a lot with Tesla. If you notice, with a stock like Tesla, the stock is so overvalued, and they come up with production issues. So here's a stock right here. Now, if you look at something like this, people don't trade Tesla because it's Tesla. People trade Tesla because it's Elon Musk. And Elon Musk he's a phenomenal marketer, promoter. He's brilliant. He's a billionaire. And he finds a way to prop this stock and keep this stock up. When Tesla was selling off, he comes up with things about batteries. He's going to Mars. He's all over the place, but he's brilliant. And anybody who was shorted against him got their eyes ripped out. So I would never short Tesla, but this is the kind of stock that follows support and resistance really well, because you can see a clear channel here. I mean, you could draw a trend line here and a trend line here. And you could stay in between these lines here. I would be very suspect about going above here, because these stocks do follow support and resistance very carefully. Okay, I'm going to look at this. We're buying above the, what else confirmed you to make that trade and go against the rule? Okay, the question was, okay, here, and here's where the question was about Win. Okay, the question was about Win, and the question was, if you only have a rule about going long above the T line, why would I go long over here and buy over here? And the reason is, Kiva, this is where experience comes in, is because markets, moves are always overdone. The market always overreacts. And because of that overreaction, it gives you opportunities. So on a normal trend and a normal moves and everything like that, it makes perfect sense to follow those rules. But here's a special situation where nothing fundamentally happened to this stock. You had something happen to this man who's been relieved of his duty and there are other things, but let's fundamentally look at what happened here. And you have to really research, and you have to kind of, some experience, does come in. Macau could care less. So Macau is in China. It's their biggest revenue source. Gaming revenues and gambling revenues. The Chinese economy is doing fairly well. and gambling is up. They love to gamble. So most of their revenues come from Macau. Wynn Las Vegas is really a lot more about non-gaming revenue. It has to do with things like conventions and events, and Wynn promotes a lot of things. So Wynn Las Vegas, and that part of the business, there's no doubt in my mind, that part of the business is going down. They are going to take a hit on their conventions. They're going to take a hit on all of those things. But you have to look past that. These are transitory events. These are binary events. This is the result of a binary event, and you're looking at a move that I don't believe, and a lot of other people don't believe, warranted a 20% drop. And you could see that the market has recovered $8.48 on a day when, let's look at the SPX. The SPX is down 25 points. So this is a very strong down day. But that's why, Akiva, sometimes you just look at special situations. Like Apple is going to report. Apple's going to report earnings. It's more of a rebound play. Yes, you're spot on. You're spot on. It's a rebound play. These are special situations. It's not a bad idea in the morning to look at what's moving in pre-market. Look at the stocks that are moving up in pre-market. Look at the stocks that are moving down in pre-market. But more importantly, look at the volume of the stocks that are moving up and down in pre-market. That's the tell. That really tells you if a stock is in play or not. Anything that's trading a 10,000 or 20,000 shares and it's down 20%, that's a low float. It doesn't really matter. And the only ones who should be trading those are day traders with direct access into the markets, because the bid-ask spreads are going to be wider than a freight train. So you don't want to mess with stuff like that. But if you see big name stocks that are dropping on some news and it's not of a fundamental nature, and when I say a fundamental nature is something happened to earnings or fundamentally something broken down, that's where you got to take a look and say, you know what, this could be an overdone situation. Put it on your watch list and just watch it. Look where the support and resistance is. Just remember, when stocks start to go on, shorts start piling on. So shorts stop piling on, dropping it down. But when the market's reversed, those shorts are going to cover because they're just in it for a trade. So what you're seeing now in Wynn, this $8 move back up, was a result of people shorting at the 50-period SMA. They shorted at the 50-period in SMA, and now they're short covering. So anybody that, I actually called this trade, and I was trying to get in it myself, but the market makers wouldn't fill me, and I didn't want to do a market order on it. So I didn't get filled on it, but that's all right, because there'll be another trade, in a minute. But this was a simple trade once you looked at the chart and you've seen that reversal pattern happen and you see the short covering coming in. But that comes with experience, and these special situations happen all the time. So when you're watching CNBC in the morning, pay attention to the news on the big stocks and what's going on, and just take a look. These moves are typically overdone. We talk a lot about earnings. So everybody wants to play earnings. Everybody wants to play earnings. I don't like playing earnings because I don't know what the stock is going to do. You don't know what the stock's going to do. They could beat on the top and bottom line and the stock will drop. And then you say, well, why did the stock drop? They had great earnings. Well, possibly because it was all baked in. And possibly because everybody knew it was going to be, and it's selling on the news because the stock has been running up. There's a million reasons, but the bottom line is it doesn't matter, because all moves on earnings are overdone. They're always overdone, and you will have another chance the next day to get in and play that stock, because you will be joining all the other people that didn't get in on the post-earning move. So it's automatic and it's inadvertent. When a stock drops a lot on the first day, it could typically move down some more the second day for all of the people that didn't get in the first day. but watch out for that reversal, because that's what you're seeing right here. So you had a big drop here, then you had a ton of people put sell orders in, market sell orders, and that's why you had the gap down. And I will guarantee you within the next day or two, we will fill this gap. So anybody that really wants to get in this, you still could get in it, because it's not going to happen in the next 20 minutes. But we'll have another conversation by, what's tomorrow? Tomorrow's Wednesday. By Friday, we'll be up here again. Again, unless some more news comes in that we don't know about that takes the stock down another leg. You don't know if that's going to happen, and I don't know if that's going to happen. I trade what I see. Okay? So basically that's my philosophy on earnings, is I trade the reaction. It's fun to play in front of earnings. You know what I mean? It really is. It's a yes or no. It's either going to be yes, or it's either going to be no. So you got a 50-50 shot on earnings. But if I don't take that bet and I wait for the reaction, well, now I know it dropped. Now I'm going to either play a continuance or I'm going to play a reversal, and I'm going to let the market tell me where the money flow is going, because I'm just trading with the money flow. I'm not trying to anticipate anything. Okay, so let me do something right here. I'm going to go down to... Okay, so markets are down 320 right now. So the markets are coming back. I mean, this is a great set. So here's the Dow. So here's your Dow. Now notice we are going to close below the T line, but we're still well above the 20 period exponential moving average. I will tell you, if we are down tomorrow, this RSI will drop below the 50. Once the reversal comes and you see any sort of buying coming in, and we trigger above the 50 and we trigger above the T line, I'm all over it. I'm back in the diamonds. Okay, so I try to make it mechanical for myself and take a lot of the subjectivity out of it, because when subjective, you're guessing, so you're saying how you feel. I'd rather trade what I know. I don't want to trade what I feel. I want to trade what I know. So, okay, that's the Dow. Let's take a look at some indexes. Let's look at the Qs. Here's an interesting one on the Qs. The Qs is this is the NASDAQ. We are sitting right on the T line right now. And again, here's your picture perfect trade. Here's my setup. We're below the T line. Our first day trading, we broke above the T line. I have all my systems are go right here. I have a move above the 50 EMA, not the 50, we have above the 50 level on the RSI. We are north of the 20 period EMA. We're north of the 5 of the T line. And then as soon as the stock breaks the high of that bar, we are long and we're off to the races. So there's your trade. I mean, that's pretty much as simple as trading needs to be. It doesn't need to be so complicated for you guys to have Bollinger Band. Look, there's nothing wrong with Bollinger Bands. If you want to have a discussion on volatility, I'll show you how to trade Bollinger Bands. And they're absolutely terrific to trade. I'm sorry, I just did something. I think I did something wrong. Okay. Okay. All right, here I'm looking. I don't know if you see this on the trade, but I see something that happened here, and I'm not quite sure how to get rid of this. This happened on Join Me. I don't want to exit Join Me. No. Does anybody know how to get rid of this? Okay, I just got rid of it. Okay, I just got rid of it. Sorry about that. Anyway, so there's my setup, and let's take a look at bonds again. Okay, here and here's your real culprit. You have 4 moving averages. We're below we're below everything here. So we are definitely in a definitely in a bear market in bonds. And that's problematic for the markets. Now, am I bullish on the markets? I am bullish on the markets, but clearly you have a lot of people here that are getting nervous because keep in mind. Share my screen. Okay. What was I saying? Yeah. The bond market clearly has to it has to reverse. It has to reverse because the bond market is definitely affecting equities, and we are up 7% this month, probably a little less now. But this has been the biggest January since I could remember, and I think we are overdone a little bit, but fundamentally nothing's changed. I just think we extended a little bit. The other thing that happened is as you know, we had tax reform, and what the analysts on Wall Street have done with tax reform is they've taken the tax savings that these major corporations are going to have, and they've
messenger audio.
Okay, give me 1 second. Yeah, Dave. Oh, my screen went away. Okay, I don't know how that happened. I don't know how it happened, Dave. What should I do? Allow Ron K to join. Everybody's joining. Oh, shit. Okay, I'm looking for it. I'm on. Okay. All right. Hey guys. Okay, I lost my screen for a minute there. I don't know how that happened, but I apologize for that. Anyway, we're still here. So anyway, so again, we're talking about the markets and we're talking about bonds, but we talked about a little bit of a trading setup that seems to work really well for me. And I use this setup all the time. Some of the stocks I'm looking at, I mean, we talked about this. Celgene was one of the ones I'm looking at. I've kind of lost a little bit of interest in it because they've done an acquisition, and that took a lot of the mojo out of it. So I kind of lost a little bit of interest in that. But clearly, let's take a look here at Apple, and here, this one is Apple is going to be a very interesting earnings announcement that's coming up on Thursday. So we've had about a half a dozen straight down days in Apple, and as you see, once we broke the 50, I'm out of the stock, right? So I'm not in it anymore. So the stock has been dropping. Clearly, there are some issues with iPhone 10. There's some speculation on sales, some speculation on parts, but Apple has become a concern. The thing about Apple is Apple always has a way of riding the ship. So it's going to be the first $1 trillion market cap. I mean, there's no doubt in my mind. And I believe that Apple. Now again, I am not going to play in the earnings, but I definitely will probably get involved in the stock one way or the other once I do see the earnings. So Apple is something I'm very interested in. The other ones are the chips. So looking at something like Nvidia, now Nvidia has just been an absolute behemoth and an absolute monster. One of the things that Nvidia is involved in is they're involved in a lot of these blockchain stocks, and the blockchain has to do with the cryptocurrencies. So Nvidia has their chips in a lot of those, in many of those servers. So this stock is just on fire, and it's going to keep going that way. So we could see we have an earnings we have earnings coming up on February 8th. We've got implied volatility starting to rise above historical volatility going into those earnings. Our RSI is above the 50 line. I would not get involved with Nvidia going into earnings, but I certainly would post earnings. Nvidia it's an excellent stock to play. But you can see that when we had our trigger, here's our trigger, here's the break of the 50, here is the close above the T line, here's your entry because we broke above the high of the bar, and then off we go. And this is a clear, easy trade because it gave you no indication of any weakness because we're maintaining above the T line, and we're certainly nowhere near the 20, the 50, or the 200. So when you say what kind of stocks do you trade stocks with charts that look like this, all right? And you just wait for them to give you the entry signal. And that's basically the safest thing to do is to trade the stocks that are showing the propensity to trend, because anything that chops around is not good at all when you are. It's not good when you are. Hang on one second, trying to read this. Okay, the question was do I think that Amazon was priced in? Okay. And again, here's Amazon. Look at how high implied volatility. Implied volatility is sitting almost at 100%. And you have earnings coming up. On February 1st. And, let's look at the Analyze tab on this. So let's go, we've got a 51% implied volatility. And, no, let's wait, I'm sorry. Let's do Amazon. All right. We've got an 89% volatility and 104 point implied move. Okay. So here's a 104 point implied move. The next week, implied volatility drops to 60. Okay. We've got a 29 point drop in implied volatility. So when we look at that, and you remember we spoke about Vega. And let's go. Here we go right here. So here's Vega. So if you've got 60 cents and you've got an implied move of 20 points, you've got a huge drop in the option premium. So that's what's going to happen. So here is an 89% implied volatility, and you have a 103 point implied move. If you wanted to do anything with this stock, the only thing you could do that makes any sort of sense whatsoever would be to play a spread. And you can do an at the money spread. If you think it's going to go up, you do something right here. You do a couple of contracts. You'll never get hurt, and it's fun to trade. But to do anything, but to buy a call and pay $5,500 or $5,600 for a call, it's not something that would make any sense to me. So I certainly would not do that. What do I think long term for Amazon? Look, I mean, we have an outside bar here. Amazon, from the retail side, Amazon is basically getting into everything. And I think it's just a matter of time. They have their own cashless stores. I mean, the 20% of every retail transaction Amazon is going to be involved in. So I think that the stock is way too expensive to be trading as an individual stock, but it's certainly a good stock to trade options on. But you need to only trade spreads on this. You have to bound your risk, and you have to limit your upside and limit your downside. And you could do pretty well with Amazon. Again, over here, we break the T line, we break the 50. So we're in play here, and then we just keep going, and this has just been clear sailing. So that's my take on Amazon. A lot of people play Facebook. It's also one of my favorites. Now, look at Facebook here. Facebook is an interesting stock because Facebook trades differently. This stock is absolutely in a channel. we're totally in a channel here. So I want a drawing tool. I'm going to take a, I'm going to do a channel. Let's do a channel here. So we do something like this. And we go here, and then we drop it down, and we go here. And this is basically what we're looking at. So the stock is trading inside of a channel, and again, let's look at our moving averages. We have broken above the T line over here. We broke above the 50. So you actually had an entry over here, but Facebook is meeting with strong resistance up here. So you need to be careful. This is a tough stock. We don't have that pretty trend like we do in all the other stocks we looked at. We don't have this type of picture, do we? We don't have that. What we have is a stock that's wavering. We have a stock that's oscillating. So if you're going to do a trade on this stock, you have to do the type of trade that basically bounds it between here and here. And again, you need to do a spread. You can't do a call or you can't do a put because you have too much resistance above and you've got support below. So you're not going to get the big move up and down on Facebook. Now, what do I think is going to happen on earnings? Well, I think they're going to beat. I don't know what their guidance is going to be, but Facebook has gotten a little bit of negative press lately because of the responsibility that it has along with Apple of being being a good corporate citizen and doing things like that. But look how the implied volatility has risen on this stock going back to December. We've risen from under 25% volatility to almost 100% volatility. So you certainly don't want to buy pure calls here. If you buy pure calls, the premium you're paying is extreme because of how high implied volatility is. However, with a spread, the spread cuts that volatility down because you've bound the upper and lower end of the risk curve. So again, what would I be doing here? If anything, I would be doing a spread, but I would be below 190. So this is a 187. I would do maybe a 187.50 to 190, something like this. So you look at it, and you could do a weekly trade going into the 10th, and again, let's put Facebook in. And let's go to the at the money. So basically, I would be looking, we're at 187.38. So we're in between 185 and 190. So I would have no problem with a trade like this. I would have no problem with a trade like this. 187 and change it to 190. So you're looking at 255, 253. I put in something about 250, and you risk 250 to make 250. It's an in-out trade, and the stock only has to be over 190. You only think it's going to move. The market maker implied move is 10 points. So because it's 10 points, I certainly think it's going to move 3 points, and that's all we really need it to move. So that's the kind of trade I would be looking at. And if somebody was on the other side, you could basically also do a put spread on that side, and it's just as easy to do. It would be just as easy to do those on the put side and do 190, 185 put. And again, look at that. Look at that put call parity. 250 on that, 250 on the other. So, basically, you could go either side. If you're bearish, you do this kind of trade. You do the put. And if you're bullish, you do the 185, 190. You risk 250 to make 250. You do a couple of contracts on that. It's a nice trade. Okay? So that's what I would do with Facebook. Amazon. Let's see. Any other stocks you want to take a look at? Anything else you want to take a look at? Type it into the message bar. Okay, I don't see any. Okay, the market is closed. So let's take a look at how Win wound up. So Win wound up almost $8. There's your trade right there. That was the trade of the day. Awesome. Okay, somebody wants to take a look at CMG. Okay, here's CMG. Okay, so here's your, let me give you a little bit of a pop quiz here. Okay, here's your pop quiz. Are we going long on this for any way, shape, or form? And my first impression is we're trading under the 200 period moving average. So when you're trading under the 200 moving average, you don't have a lot of institutional participation. So that's the first thing you got to know, is there are a lot of institutions that aren't touching this stock. And because institutions aren't touching this stock, you're dealing more on the retail side, day trader side. So you're going to have a little bit of volatility there. If you did want to take this thing long, here's my trade, right? I hope you guys got this set up and you start playing with it, because it works on daily, it works on 60-minute, it works on 50-minute. This works on anything. This trade setup works on any setup at all. Implied volatility is not going to matter on less than a daily, so you don't even have to pay attention to that. If you just had this and you wanted to go on a short term to do an intraday or a 1 or 2 day trade, and you didn't want to trade off the daily, trade off the 60-minute, trade off the 30-minute. It works exactly the same. It'll work exactly the same. So what I see here is we have dropped below the 50. If this stock were to reverse and break above the T line, and this reverses and goes back up, I have my slingshot. That would be my trigger, and the buy would actually come on the break of the top of that bar. So right now, you have earnings coming up in a couple of days, so I would be very cautious going into earnings. But if earnings weren't here, that would be my take on this stock. However, there's so many more stocks I'd rather be involved in than something that's sitting under its 200 period moving average. Okay? All right. Somebody wants to know about Grub. Okay. Grub, interesting stock. Again, I mean, in looking at those chart patterns, here was your real entry. Your real entry was on this earnings here. Anybody who got long on these earnings, so you wouldn't get in on this bar, but you certainly could have gotten in on this bar because you broke above the 50. Here was your trigger. Here was your entry on your break of the top of this bar. Okay? We're above, one second, I'm writing a note to do Netflix. You see the stock moving up, moving up, moving up. Okay, so we're just coming inside of the T line here, just coming inside of the T line, but we're not really testing the 20 exponential moving average. We're good. Again, now you see this thing moving side. Once you see the T line change its slope from up to sideways, that is your early warning system that something's up with this stock. So the slope of the moving average is very important, especially on a short-term moving average. So here's your kind of early warning. Here we broke below. We didn't touch our 50, but here I'm looking at really getting ready to exit this trade. So here's the 50. Again, remember the 50 is the line in the sand. You typically have a lot of traders sitting here at the 50 trying to make decisions on what to do. So here we broke and closed below it. Buyers came in and bought it. So here you have a standoff. What happens next? You have a buy. We break the T line. Again, we're sitting around these 50s, so you have to kind of use your judgment here. I'd be kind of leery here, but here's a clear breakout right here, and you could take this trade. And then you take this trade. Here you have a candle set up that's called a shooting star. And this shooting star indicates price rejection. And then you have a drop down over here. So this is a stock that's kind of in a sideways state of flux right now. So I'm not really bullish on it, but it's an interesting stock with the right setup. So somebody asked about Netflix. Okay, Netflix. What can we say about Netflix? So Netflix had a period of consolidation going all the way back to October. This is not a stock I would have been involved in over here. I mean, you could clearly see that. Look at the RSI. The RSI doesn't know what to do. We have no trend. No trend, no trade. So there's a little saying for you. No trend, no trade. But all of a sudden, we got a clear break above the 50 and a close above the T line. We're above the 50. We have a T line break. We're above all of our moving averages. You can enter right here. You enter right here. You have clear sailing. No reason to get out of this trade. You're not taking any heat. You're making money. We're all happy. All of a sudden, you have earnings, and the earnings explode the stock. So the earnings explode the stock. We're way extended. We were way extended. We basically went from 200 to 286. So somebody says, where do I see Netflix from here? I see Netflix as way overextended, but it's one of the strongest stocks in the market. So am I buying puts or am I shorting it? Absolutely not. I'm respecting it. We have an inside bar right here. The stock could break below it. The stock could break above it. How much upside does it have? Nobody really knows. All I know is that I don't understand who's buying at these levels. I mean, I'm personally not. I'm personally not. But implied volatility dropped on earnings. You see that historical volatility has been up because this is a volatile stock. And basically, that's where it sits. I would just be watching it and maybe playing the next trend. But I would need this stock. The further you get away from the T line, the more likely you're going to have a pullback to the T line. So right now, I'm certainly not buying this stock. Gravity eventually pulls these stocks back in, and the T line is going to be the first stop. So I'd say I've got a target right here of maybe 260 to 265 on this stock short term. Okay. I see a note. Would be nice to have a class after trading hours. Chris, we could certainly do that. These are recorded, so you'll be able to look at this, tonight, tomorrow, any other time. But yeah, we can do an after hours class. We could certainly do that. We could talk to Dave. So, other than that, I wanted to teach you this setup. This is a major setup I use, and I use it with the daily bars for options because I want to see if implied volatility is expensive or cheap. And when I say that, I mean relative to itself. So if it's in the lower end, I could say here that volatility is cheap. Once we broke above the historical volatility, it started to get expensive, but we were also starting its run up into earnings. So again, you could start to see when you could go long options over here or long spreads and feel pretty confident that the volatility is going to take the price up. But make sure you're out of it by earnings because you have a huge drop off in volatility after the binary event occurs. Okay. Somebody wants me to look. I'm going to take a couple of more than close this. Somebody wants me to look at UAL, United Airlines. Okay, United Airlines. Here we go. United Airlines had an event, so we had earnings, and we could see what happened with earnings. But the airline stocks, you have to look at it as a sector. So what did Delta Airlines do? What did JetBlue do? What did Southwest do? These are sector plays, right? I mean, you can't play one without playing the other because they kind of all follow in tandem. And so you could look at Southwest Airlines and you could see the stock. The stock was doing very well. Here was your trigger again. Here's my setup again, right? We break above the T line and we cross the 50. This is a really good setup, guys. I mean, you're in the 75, 80 percentile here. Just redo your RSI. Look at the video again. It'll tell you exactly how to do it. Redo your RSI. Forget that overbought, oversold stuff because that doesn't mean anything. What you're really looking for is a trigger. So you're looking for a combination of a trigger off the 50, a trigger above the T line, the break of the T line is your buy point, and you're sitting pretty until you start to close below or you start to see the T line flatten out. That's your early warning, right? And then sure enough, we broke below the 20. We had a couple of responsive moves here, but we were getting too close to earnings here. These were just moves in anticipation of earnings, and the earnings set it down. So I think that the airlines is a sector play, and they're going to kind of move in tandem. So again, here's United Airlines. You could see what happened there. So this stock is right now below the 200. It's below the 50. I'm certainly not going long it. However, if I see the sector start to move up and my moving averages align and I break the 50, again, it all goes according to the plan. Plan your trade and trade your plan. And if my plan is to follow this setup, I'm going to follow this setup. So you could do it on a daily, and again, you could do it on a 30-minute if you want to do intraday. It all works the same. It all works the same way. It's just whether you're trading short term or you're trading long term. So basically, that is what I wanted to cover today. Any final questions? Tony, can you post a shared URL for your TOS chart setup for the members that use TOS? I absolutely can. So what I'll do is I will do a share of this and I will send it to you and I will post it. Let me write a note to that. Now, keep in mind, guys, these are not any proprietary indicators or anything like that. This is on, I don't care what chart setup you use, what platform you have, these are there. I am not 100% sure that every platform has implied and historical volatility. I would hope it would have at least implied, because implied is going to tell you, implied is, of the two, the implied is more important because that tells you about when you should start looking to buy options going into the inevitable implied volatility rise going into earnings. That's real important, and that's an easy trade, guys. That's an easy trade because it happens all the time. People anticipate going into earnings, and positive volatility raises option premiums, and if you buy options like buy calls or buy puts, they go up in value. So think about the type of trades that profit from that. You have calls, you have puts, you have call spreads, you have put spreads. What doesn't profit from that is short options or selling options, which we haven't talked about. And if there's anybody advanced that ever wanted to see a class on how to sell premium and how to take the other side of the trade and sell options, I'd be happy to do that. I got to beg to do one more. Sully, give me 1 second on that. I'm going to look at ATV for one of our members. Okay, Acorn International. This is not a stock I trade, but it follows the same, it looks like it doesn't have a whole lot of average true range, that it's not the most intraday, it doesn't move a lot. So the stock is kind of all over the place, but follow your rules. Let's take a look at it. I mean, let's follow the rules. Where did we break? Here, we're moving sideways. I'm not interested here, but I'm getting interested over here because we broke above the T line and we're above the 50. So I'm following it. I'm good. I'm good. I'm good. I'm actually good all the way, and then I'm good to here. And then over here I had a drop. But even if I took this as a regular trade, it's still a profitable trade because, we moved from here to here. Where do I see it going from here? I don't know, and you don't know. Nobody knows. However, if we have a method and we have a setup and we like this stock, the reason we don't see all the trades is because I'm just looking, it's an ADR. ADRs are foreign stocks and they trade at hours that we don't plot. So you're going to see a lot of chop like this. If you look at GLD, you'd see the same thing. Anything that trades 24 hours or in hours that our markets aren't open are going to look something like that. Okay. The last question. Okay. The last question is somebody wanted to know, again, to explain how implied volatility plays into it. Implied volatility is really, if you're going to trade options with this, you want an idea of where the option premium is relative to what your strategy is. So if you are doing a spread, and Dave has done spreads on this, and I don't know if he taught you how the positive and negative deltas cancel each other out, and I could certainly do a spread too. I could do a spread class also. But if you're just going to do a call or a put, and I know in this room we buy a lot of calls and we buy a lot of puts. If we're going to do that, we want to know if the option premium is expensive. And when I say expensive, I'm talking about expensive relative to itself. And every stock has its own personality about how much it moves. It's called its average true range. But if I'm looking at implied volatility, and implied volatility is sitting up here, and historical volatility is sitting here, and you want to know what I think about it, I think that option premiums tend to be a little bit expensive because it's trading above its historical volatility and it's at the 75 percentile. Conversely, when it was down here, if it was down here, I would say implied volatility was pretty cheap, and you could probably get a good buy on buying calls and puts. So that's really what that's all about, is it expensive relative to itself? The other thing is knowing that as you get to earnings, your implied volatility is at its peak, and you know right after earnings, it's dropping down. So if you're going to buy options, you really don't want to speculate and buy here because you don't know what the stock's going to do. But being a buyer after the implied volatility crush is typically a pretty good trade from an option standpoint. Okay, so if that's it, I'm going to let you guys go, and hope we had a good class. Sorry we had a little bit of uncertainty going here. I'm still learning this Join Me platform, but this is going to be recorded. This is being recorded. It's going to be posted. You could look at it again. And please try that setup. It's a simple setup. It uses 4 moving averages, and it uses a modified RSI and a couple of volatility standings, and it's really simple. And your trigger, again, last time, and then I'm getting out of here. Your trigger is a break below, which is your pullback, a break above, and at the same time, we want to close above the T line. That's your trigger, and your buy point is the next day when it closes above the high of your trigger bar. Okay? Couldn't get any simpler than that. Okay? Trigger bar, close above. Okay? Thanks a lot, guys. Peace. We had a great time, and we'll do it again. And if you have any questions, post them in the chat room. I'll take a look tonight. I got some stuff to do. I'm going out to dinner with my wife, but I'll take a look tonight and see what you guys posted. And if you got any questions on some stocks, I'd be happy to give you a hand with them. All right? Thanks, guys. Have a great day. Good trading, and don't let that 362-point drop get you, because we'll be back. All right? Look at the bond market. When the bond market goes up, we're going to go up. All right? Thanks. Bye, guys.